this chart really quick. And I'm going to go back here to a 90-day chart. I'm going to zoom it in. And I'm going to go back to the day we actually put this box here. It was at our August 25th webinar. A couple people kind of got upset because I told them, I was like, listen, stop looking at these little dead cat bounces thinking that that's where you're going to crash. Your premiums are still too high and it's going to go up farther. And at first I was actually just making a guess based on this consolidation period. The question I have for you is, at this time, did you doubt that we would trade in this box? Absolutely. Hey, I even had some doubt, even though I was constantly trying to reassure myself of those prior chart times that we had talked about, and I went over and over again, and I was still trying to reassure myself constantly that we would trade in this box. Now, here, we talked again about a specific statement I made. I said that from this point, if we were going to continue trading like we had those prior times, which to this point we had been identically following, that we would revisit the highs and lows of this range several times. You guys remember that? Okay, well, you might not have doubted that here, because you might have looked at this saying, I hope we revisit that low, but I think we're going to crash. So I don't think we'll revisit the high again, but we're going to crash here. But just a couple days later, it started to look like we weren't going to revisit the low end of that. And I'll admit here, I actually started to have a little doubt. I was like, hold on a second, this isn't acting right. I'm positive we're going to revisit the highs and the lows. It's got to, because everything else is just lined up so perfectly. Well, we ended up coming and, oh man, we again did not revisit the lows. We double bottomed. Almost looks like we're going to have a big breakout. And as time progressed, it started to create doubt that we'd see those lows, correct? As a matter of fact, if you guys remember, proof of my doubt of it, that last fall, most of my stuff was to match up with these bottoms here. Most of my put plays were actually to match up with these bottoms here. Because it was like, well, I'm going to trade to there, and if it gives me more, great. That's proof of my doubt, even, that we would completely trade in the box. And the reason I keep going over this is to show you it's important to stick with the plan that we have that didn't involve that emotion. Because when you started to think about it too much, it created doubt, and it probably made you miss that right there. So now at this point, we've got multiple times revisiting the highs, multiple times now revisiting the lows. It starts to lessen our doubt, especially when we see this, right? I'm sure by last Wednesday morning that you probably looked at this and said, you know what? I'm starting to think this blue box is right. Am I correct in that? Because I kind of got that feeling overall from even people in the chat room that might have been more doubtful of it before, but it seemed like last Wednesday people started to say, you know what? I'm willing to take the chance, even on Wednesday, buying that gap up, because I'm confident we're going to go and revisit the highs. Now, the reason I said 1985 to 1995 was because I still believe that the highs and lows that we will revisit are the highs and lows of this week, which took us into that 1995 area. From the statement I made back here that we would revisit these highs and lows several times. So even though we went a little bit higher here, I'm still personally looking primarily at a range of that first week's highs and lows. And by the time we got to this point, it seemed like there was quite a bit less doubt in this whole finagled crazy box theory, right? I'm pretty sure Moss got on board with the box the last 2 rounds. Now, we got a little bit wicked, but here's the thing. During this time when it got a little bit goofy, what do you have to rely on for your trades? What do you have to constantly remind yourself of? Because before it popped out of this goofy range, we spent a couple, 3 days of, it's kind of goofy and it sucks, right? It's kind of goofy and it sucks. What do we have to rely on? And I talked a lot about it last week when we were in this time. That we need to watch for the top of the box, right? We need to hold on and be patient for the top of the box. I talked about it when I took the 10-16-102 calls plays for the Qs. And are you seeing why we wanted to start getting rid of those calls these last couple days? Could it go up to 2,000, maybe a little more? Yes. Did it go to the area I was looking for, 1985 to 1995? Yep. I wasn't trading personally for that smidge, the what if it goes a little bit higher. It's kind of like, for me personally, how I teach trading W patterns, right? A lot of people would say on a W pattern, target the prior high. I tell you to look at the highest close after the start of the fall. And by your own experience, some of you that have been around a little longer trading Ws, which target point for a W, the norm or mine, hits at a higher percentage? It might break it, but which one gets hit more? And the difference in that is really an understanding that people that hold on for that smidge, that, ooh, let's just see if it gives a little more. And we've all been there before. Let's not deny that. When we've got a really good trade and we try to hold on for that smidge more, what has typically been your result? I can tell you what mine has been. It has typically been something like this, and I'm going to mute the video or I'm going to pause the video to. So if you're watching the video later, you don't get to hear my reaction, but I'm pretty sure it's always the same reaction. It's where everything's going exciting and then everybody gets silent in the chat room, right? That's what it is. We didn't hold on for the smidge here. Didn't hold on for the smidge here. But have I made a very clear, conscious effort to have you still identify that 2,000 level as still potential upside for the SPX? Through my conversation of not buying a whole lot today, recognizing what I bought, I cannot be scared if it goes up here. As a matter of fact, I'll be 100% honest with you. I don't care if it breaks above there. I will hold my puts. Why? Because I still believe, just like we got proven back here on the Fed day, I still believe that the majority of trading that we're going to see over the next couple months still is going to be in this blue box. Now, the majority does not mean 100%, does it? So we could break it. We might even break it for a couple days, up or down. Might happen. But for me, I want to focus on where the majority should lie. Remember last week's webinar, before we got into tweaking our strangle straddle strategy, we talked about a trade to make if we fell below the box. Does everybody remember that? We actually talked about waiting for the SPY to fail 1862 first, or the SPX, not the SPY, to fail 1862 first, the lowest close on the daily, and to trade it into that 1821 area, the lowest overall price in the last year. Remember that backup plan trade? Well, that's where we're going to kind of talk about starting now. We had a backup plan trade for if we would have kept going lower after last week's webinar. If we go higher after this webinar, we need to understand what it is we're looking for. To do so on this daily chart, I'm going to take it back to 3 years. Do you maybe see why I can take it back even further? Let's go 5 years on the daily. Do you see why I want to take it back this far really quick for you to see something? Hint, hint, it's this line. What line is this? This line started right after that fiscal cliff period. It's the QE2 line. Here's your QE1 line. QE3 line's gone. See all these bottoms here? They bounced really nicely off QE3 line, trend line until that dip. Oh, that was when QE3 went away. And we did go up higher, but now we've got the QE2 line. The majority of the stimulus involved in QE2 actually involves the controlling of interest rates. Last I checked, unless you've been living in a dark cave, interest rates have been the top conversation in the media, right? They might mention other things that come and go, but every day they mention interest rates. We've got a consolidation range. In essence, you could even kind of think of it like a W. There you are. It's back at that neckline from our weekly chart, right? Is that what you're talking about, Leonard? Well, our backup trade, okay, our backup trade, in case it goes above the box, it's going to be real simple. We're going to watch for a daily close above 1995.31 or any price on the SPY above $200.18. Write that down. SPY greater than $200.18. And we're going to look for a calls trade with a resistance target of either another, I say another because it already retested this trend line once, another retest of this trend line, or a retest of these swing lows. You need to write that down because most of my alerts, starting tomorrow, and even actually you could say starting today, are dependent on that belief that, hey, it's telling us we're trading in the box, so we're going to trade in the box. We're at the top of the box. That means we're going to trade to the short side, right? So how important do you think it is to be aware of if the SPY breaks above $200.18? How important do you think that is? Now, a lot of times I talk about scaling into trades, right? Not getting in too heavy with one position. Do you guys remember what I said about the SPY over and over and over again? It's the ultimate what chart? Ultimate blank chart. The ultimate chart to use to blank your other positions. Leverage. Right? It's the ultimate chart to leverage my other positions. For a long time, most of you only saw me taking short positions in the SPY to leverage other trades. Why? Because I had a lot of long-term positions that were longs, and when it dropped, I got scared. So instead of selling those, I wanted to buy puts to leverage. If I'm looking at this box as the means which controls my current trading habit, I have to be looking at this, not saying, well, what if it goes above, and then not making any trade for it to go down. I need to focus on making my trades for if it stays in this box, but have my trade planned and ready for if it breaks above it. And you know, you could say, well, why don't we look at every individual stock and see how we could straddle or strangle right there? There's actually a much better way. That much better way involves not scaling into a position, because with the watch list that I've got for coming down, I mean, it's pretty much the same stocks we've been trading, but it means we're going to be pretty heavy on the put side of stuff, just like we were during that last fall. And if we're going to be heavy on the put side of stuff and not heavy on the call side of stuff, that one fail safe needs to be a heavier position. Do you guys understand why I'm saying that? It's the only way it'll truly outweigh and leverage against the other positions. So this trade that I'm talking about is something that if we do break, and like I said on the SPY, it would be any price above $200.18. I want you to buy not a third position, not a 1/2 position. I want you to buy a full swing trade position, a full position that you would use for a swing trade of the SPY 1016-201 calls. If you want to put it in as a conditional, which I'd really recommend you do, that conditional would say SPY greater than or equal to, I used for mine, $200.20 to buy the 201 calls with a limit order of 1.75 good till canceled. If you're going to enter that limit order, right beside that sign on your desk that I ask you to put that says SPX 1800, I want you to also put, if SPY 1016-201 calls fill, enter good till 0.45 trailing stop on half the position. Copy and paste that somewhere. Copy and paste that somewhere. The reason is, for what we're trading out, 1 to 2 weeks, sometimes 3 weeks, if we were to waste a week coming up here, we could have stuff that expired worthless, couldn't we, on our short side? Couldn't we get into a position where, ooh, even though we think it's just going to come up here and fall again, the short side could take a beating, couldn't it? So we want to get a bigger position, but we want to put that trailing stop on half of it right away so that no matter what, we're limiting some of our risk to the downside. And of course, just so you guys know, if we get filled on that order, I would be alerting the sell on the remaining half, because that right there is your alert being put right there now. everybody sees where I'm coming from on that little fail-safe trade, just like the trade we planned last week that I talked about for 45 minutes that we didn't even end up using. And the reason that trade is so important is because it's the one thing that can save us if it goes above that box. Why? Let's think about it for a second. How many times do you have to see this box traded within over and over and over again before you say, you know what, it's time to start trading that box? And we need that fail-safe trade, because without that fail-safe trade, all the other trade plans could hurt us if we're wrong. And let's face it, it is possible to be wrong, isn't it? So, oops, missing a chart on here. Which one am I missing? Now we're going to come over here. I'm not going to lie. I think Apple could still go up even if the market goes down. Why would I think that? Well, last time market started going up and Apple still went down a little bit. So could it happen? Yep. And I think it still needs to at least get to that 112.50 area to really catch up to what other stocks that we watch and trade have done. Now, I don't want to say this in a way that's perceived as rude, but if you haven't realized that this is the point of the webinar that you should have a pen and paper out, please take the time to get it out, because you need to be able to care enough about your money to understand what it is you're looking at and not just follow random things that you get and go, oh, I'll jump over here. Oh, I'll jump over here. We need to make sure we understand what it is we're looking at so that we also understand why it is we're still okay maybe holding something that might be down. Don't think I don't have a lot of puts right now that are down that were entered on strangle and straddle points, because I do. Most of them, not all of them, were strangles where the calls made more than the puts lost. I point that out because that means there are some that even though the call sold, I am still down on the overall position. But if we're at the top of the box, and if by chance we make a move to the bottom of the box, what is likely to happen with those puts positions that expire 10/16 and 10/23? I won't say they'll come back and be winners, but there's a chance that when I sell them, the overall strangle could still be profitable, right? And that's the important part. You see, I mention this all the time when we do strangle and straddle trades. We'll sell one side of it, and then within a couple days, everybody forgets we have that one side of it, right? It's like, oh man, I'm down on this. Yeah, well, happens. But we've got to watch for the time when we can legitimately find points to make the entries. But I think we all pretty much know now where we're selling, don't we? Last week, we talked about tweaking our strategy of just buying the strangle and straddle at every line. Remember 2 weeks ago, I tried to make it simple. And if you go back and follow the trades that were alerted, did I have strangles and straddles where I made like 25% on the calls and lost 18% on the puts? Yes. There were a couple of those. Did I have a whole lot of them where I made like 50, 60% on the puts or calls, and then on the other side lost 20%? Yes. But think about that. A strangle or straddle trade is not just one buy, and it's not the winner or loser, the winning or losing percentage on the sells, it's the combination of the win and loss percentage on the sells, correct? So if we went back and looked at even that very simplistic strategy we talked about 2 weeks ago, where it was at every line, buy strangle straddle, gets to new line, buy strangle straddle, put trail stop on other strangle straddle, and then you go back and look at it, those trades that were made during that first week of us, which was 2 weeks ago, you actually say, hey, that worked. We tweaked that a little bit last week by saying, listen, we're coming off the bottom. We're going to take a first strangle straddle position. But if we're just going to keep breaking above lines, then what we're going to do is take that first strangle straddle position. And when we get to the next line, say, just take the calls. And then, you know what? We get to another line, just take the calls and only look for the put side if we were to break back down below that line. And a few of us, you know, Apple actually hosed me in on that a little bit last week. But I could also say Facebook or CVX hosed me into a couple buys that I might have wished I didn't make. Do you think I cared about those yesterday and today? You think I cared much about the times where it made me buy calls, but then came back and made me buy puts? When today the highest call strike I had was 81s, and we were sitting at 87, I didn't care much at all. I don't care much at all that the last set of puts I bought on CVX before today's alert is down a whole lot, like 86%. Why don't I care about that? Well, it's free now because the call's paid for it. And now that I hit the top of the box on the SPX, we've all clearly discussed, and it seems to me like we've clearly agreed that that next expectation is the bottom of the box, right? We've talked tonight, and I've asked for your answer on if you started to trust that box yet. And, you know, everybody that did answer is like, oh, yeah, you know, the trust is definitely getting greater in that box. Is there anybody that disagrees with that? That everything we've talked about with the box on the SPX looks to be like, if you don't believe it, you probably don't believe that the grass is green and the sky is blue. You probably don't believe many things that are just blatantly obvious. So let's think about that for a second. Since tweaking a little bit, and the tweak we made last week, I will have to say, took many of the exact same trades we had made the week before and gave us a little extra profit on it, exactly what we intended for it to do. How could we tweak that further? How could we tweak it further? Some of you that have been here a while might remember a long time ago, I did a webinar series on swing point trading. Some of you like Moss and Leonard that have been here for quite a bit. Ryan's been here quite a bit. Do you remember me talking about the 2-line rule? If it failed 2 lines, it's time to go, right? That's what we talked about. Let me ask you this. With your current trust in the box, where do you expect the SPX to go now, even if it goes up some? Where do you expect the SPX to be a week from today? Okay. So what I'm getting at in getting ready to talk about this 2-line rule, I want you to understand that we cannot look at holding all of our puts plays to here and not putting trail stops on them like we did last week. We cannot look at that. unless we have a plan for the risk side too, right? Because it'd be very, very easy for somebody right now to say, why don't we just buy puts and hold them till the bottom line? And my answer to that is because the easier this seems to get, the harder it will become. Does that make any sense to you? Basically, what I'm getting at is you don't think the computers that control all this start to realize people are catching on? And as they realize people are catching on, do you not think that they're going to do things to make it a little harder? What we're going to look at is something that is commonly referred to as trade stacking. Does anybody not know what I mean when I say trade stacking? To make it quick and easy, trade stacking is, we had a couple trades like this last week where we got the buy on calls and then it kept going up. We put the trail stop on the first set of calls, but we were stacked in two sets of calls here on Facebook. Right on Wednesday, we bought right at the open. We already had a set remaining from the day before. It comes up. We had a trail stop on the set. It came clear up to this line. The trail stop hit on the 89 calls as it pulled back, but we kept that other set of calls we had. So we were stacking the trades up into this. What I'm talking about is stacking the number of trades we get in a direction. It almost sounds like Coach Mike's getting into a trading system that he still trades a lot, but we don't really talk about very much. The 50-50 trading system. And it's going to be very, very similar to what we've talked about with the 50-50 trading system, with the exception of what? What do you think is going to be my exception? Because they're not going to be 50-50 trades. I'm telling you that right now. The 50-50 system is not a good system to use right now. Do you know why? Our current consolidation range is better than a 50% gain. 50% is too little. Remember the 50-50 system, we set a 50% profit limit sell, as well as a 50% trailing stop. I don't want to sell at 50%. Why? Because while there have been some that have sold at 50% or maybe a little lower, there's been some CVXs, there's been a whole bunch of Netflixes, there's been a couple Facebooks, one or two Apples because it hasn't been moving that much, quite a few Baidus, and even trades on the Qs that 50% would have pissed me off when I look at what we actually did, okay? But that whole trade stacking philosophy and a little bit of implementation of the 50-50 system, as well as what I've referred to in the past as the two-line rule, is all going to get intermingled together for this further evolution and tweaking of a trade system to again have the goal of producing higher profits on something that is still profitable. We're not trying to tweak something that's failing, we're trying to tweak something that's working. And what we're going to get at with this, if I talk about the two-line rule, and let's just look at something like Netflix, okay? I'm saying Netflix because I got a bunch of lines in here and it'll be easier to discuss. If Netflix were to drop this line here that I have at about 103.20 and fail below that, which means I have my puts on this dash line, I get more puts here. If it fails this line tomorrow, I get more puts if it fails that line. That'd be how many puts plays? 3. Would that not be what we're talking about with stacking our trades? And what I'm going to get at with this is, you know, I sent out an email on Sunday and I told people that, some people have been like, well, how come you're not sending like the traditional watch list you used to do? And I've tried to tell people over and over again, because now's the time to study more of your trading system than it is to study the charts. And I've spent a lot of time doing that, by the way. And what I found on all 6 of these charts is that if I make it 2 lines from where I bought each trade, and I then enter a 50% trail stop for not what that option is at the point I'm entering it, but off of what I bought it for, that to a point of accuracy, quite literally in the range of 87 to 93%, it won't stop me out if it retests 1 line above it. It'll stop me out if it breaks above that 1 line above it. So we're going to use the 2-line rule, honestly, with an opposite effect. So before I confuse anybody, I want to kind of explain what we tweaked into last week. Last week we talked about, well, guys, we're expecting more of an upwards move, so we'll take our initial straddles and strangles, and then each line we go up to, rather than buying calls and puts, we're only going to buy calls, but we'll put a trailing stop, a very tight one, like 15 cents, on the prior calls position, right? And then we go up to the next line, we'll buy again, just a set of calls, we'll put a 15-cent trailing stop. Why did we do that? Because, like I told people, you might not be comfortable with a 50-cent, $2 trailing stop, depending on what you're buying. But you have to be willing to risk more to have the potential to gain more. Does anybody disagree with the statement, like with higher reward comes higher risk? Pretty much any type of trade you look at, the higher the reward potential, the higher the risk potential. And if we don't plan for that risk, we're not going to be able to reap the reward. The reward in this case would be able to have as many puts plays as possible at what point on the chart? Bottom of what, Ryan? The box. There we go. Without putting ourselves in a position where, I mean, you could say really easy, well, coach, I know how to have as many puts plays as possible at the bottom of the box. I'm going to buy them all right now. Is that a healthy decision to make? I mean, it might later prove that you were right, but is it healthy to do? I mean, how many times have you really thought something was going to do something, and then you look back later and go, whoa, it didn't do it? So we don't want to just load up all at once, as the penny stock idiots say, loading the boat. Go ahead and load the boat, mortgage your house, put it all in puts. No, we don't want to do that. We want to strategically buy those positions and still have, we could just say, what, we're going to hold relentlessly no matter what till the bottom of the box. But you know what? What if it does what it did not long ago, where it only came down halfway of the box, went back to the top of the box twice before coming down to the bottom of the box? That's going to be pretty stupid to hold those positions that whole time, right? So I've gone through literally the past month, since the day we entered this consolidation range, even when the premiums were ridiculously high. And I looked at something that some of us are familiar with, and others might not be, but it's something I can be consistent with because we've talked about it before, that 2-line rule, and a little mix with the 50-50 system. And what I'm talking about with this is, going back down here to this Netflix chart. I bought a set of puts today. It comes down to this thick line, I'm going to buy another set of puts. If it comes down to this line here, that's 2 lines after my first buy, right? Now you could say, well, that would be another puts buy. Yep, but what should I do with my first puts buy? I want you to assume that I paid $2 for that puts buy. Now, down here, it might be at $4. And I'm talking about the 50% trail stop. I would enter what as my trail stop, Ryan? 50 cents, right? I wouldn't, if it's at $4 here, or I'd enter $1. You're right, sorry. If it's at $4 down here, I don't want to say, oh, 50%, it's $2, because that takes it back to what I paid for it. I want to take it to half of what I paid, which would then guarantee me what? In that case, still a 50% win, or at least some sort of win at that point. And I've got to manage that in 2 ways. So what do you think is going to be a really essential tool for us to use? We talked about this the last couple of weeks, and actually on these lines, we would right click, and then we would hit create alert withdrawing, and then we'd set this to crosses, and then we would enter an instruction like before we would say like buy Netflix 10-9, 107 calls, 103 puts. We can do it with conditional orders. That's possible too. But if we just want, if we're going to be sitting here watching it and we just want to make the trades ourselves, on these alerts, we should not only say buy Netflix 10, and I'm saying 10-9 because next week's the earnings and the premiums are crazy. So that is a little more risky on Netflix. You might say, I'm not taking that risk. I'll do it on another. The example's still valid. So at that line, I might say, hey, my next line below that's below 103. So I'm going to buy 103 puts. And this is how we were doing our alerts before. But what else I need to do is I need to look at my Netflix 104 puts that I bought today at $1.45. And I need to take $1.45 and divide that by 2 and find that that's 72.5 cents. And I need to actually give myself the instruction to place a 0.72 good till canceled trailing stop on Netflix 10-9 104 puts. Why is that helpful? Well, have you ever been trading during market hours and you get focused on one thing that might be happening on one chart and you get an alert and you just ignore it? Or it's like, man, what did I have that alert for? By the time you look at it, you're like, oh, shoot, I really wanted to trade that alert. You can move a lot faster if your alerts have actual instructions. You can move a whole lot faster and more efficiently. Some people ask me sometimes, did you just guess what trail stop to put on there? Sometimes I'm honest and I say yes. I say, yeah, I just guessed the number. I wasn't willing to let it go down more than 20 cents, so that's what I put on it. Sometimes I actually come with a calculated number, right? Like, hey, we're going to put a 42-cent trailing stop on this. See, people go, whoa, why that number? Well, that's what I believe it could still lose. It could lose 41 cents down to that next support, but if it bounces there, I don't want to get stopped out. So 42 cents means if it fails that support. Oh, okay. Well, in this case, where's the 72 cents coming from? It's half of what I paid. And not just because it sounds good, but because I spent the time to actually research the options activity for stuff that moves a single line versus 2 lines. I'm okay letting it backtrack 1 line. I don't want it to backtrack 2 lines. So I don't want to stop out if it backtracks a single line. I want to stop out if it backtracks 2 lines. That trailing stop will help you do that effectively and efficiently. Also, we could go back and look at ones like our Facebook $90 calls, $92 calls, and we could say from last week's buys, man, a 15-cent trailing stop, I got stopped out kind of quick. But, you know, I would have rather let it go down some to be able to sell it today or yesterday, right? I'm not the only one that looks at those positions and says, man, I paid $1.70 for Facebook 10-16-92 calls last week. Today, or yesterday, sorry, a trailing stop hit them at $3.19. That's a good gain. But last week, I had other Facebook calls that I entered a 15-cent trailing stop on. Here's one. Facebook 10-9, $89 calls. I bought them at 162. The trail stop hit at 242. Those expire at the end of this week. What would the intrinsic value have been on those at yesterday's high, 94 bucks? Just the intrinsic value, the value not affected by time decay. 89 calls at $94, I could have at least sold them for what? $5, right? I don't even need to look up what they were at. I know I could have sold them for $5. Do you guys understand that? Because an $89 call when the stock's at $94 is at least worth $5 on expiration day. But you know what? On that exact same position, if I'd have put in a 50-cent trailing stop, it still would have stopped me out. It still would have stopped me out. If I would have put in a 60-cent trailing stop, it would have stopped me out. As a matter of fact, I could have put as high as a 78-cent trailing stop, and it would have stopped me out before it hit yesterday's high. Here's something funny. An 81-cent trailing stop, which is 50% of what I paid for them, would have triggered in the first hour today at over $5. Do I wish I would have let my calls go up to 265 and then back down to 150, or not quite 150, like 190 before they ran over $5? Yeah, you bet. I had a couple CVX calls that, based on how we discussed trading it last week, I put some trail stops on that wiggled. One of those two calls, trail stopped me out. Crap. And I should have still had that yesterday and today. As a matter of fact, that first set, the $78 calls that we bought for 1016 last week, if I would have had a trail stop based on 50% of what I paid, they would have sold today at about 230. Think about that. Mine sold Wednesday afternoon. They would have sold today at 230. By the way, Facebook at 230 today was up, or not Facebook, CVX was up today at 230, about $9 higher than it was last Wednesday when my trail stop hit. So when we talk about an overall execution of this, we could actually say to somebody that maybe has never traded before that our expectation would be, after getting in an initial strangle, if it was a perfect world, a textbook scenario, we would have nothing but what types of trades being made over the next few days. Puts, yep, we would just, at every line we'd buy puts and it'd never cross back above. Do we live in a perfect scenario type world? You know, last week I actually drew little boxes and said, isn't it more like this will happen? I had like a couple green candles and then a red candle that dropped below the line. And I said, see, that would make us buy puts. And it was funny, the chart I drew that on actually did almost identical to what I drew it on. It was actually really funny, to me at least. And it was like, but it lessened the occurrence, right? We didn't have to buy puts at every single line. But there were a few times we had to take both sides, right? Keeping in that same mindset, but not putting the trail stop on another set of puts this time just because we bought another set, but trading that 2-line rule. Once it makes it 2 lines to put the trail stop on, it is going to have us more efficiently trading for the bottom of the box, isn't it? And, just like last week, I had some people say, well, why didn't we just talk about that 2 weeks ago, when you talked about just the strangles and straddles? Well, I didn't want to overcomplicate it. I knew the first way would work, and it did. I knew last week's way would be a little bit better than the first week's way, and I know this way will be a little bit better than last week's way. And the goal here is to grow as traders in a way that we can all understand and follow along with. So looking at my grid of charts here, I want you to look right here on the right side, the one in the middle, the Facebook chart. Let's just go through a scenario real quick. We're going to make it really easy. Without currently having a strangle, if it comes down to this line, we'll say at roughly $92. Tomorrow, we'll make the changeover to buying the 1023s, right? So we know it'd be the 1023 expiration. What calls trade will we look to buy at this $92 area on Facebook? So we can get our strangle. $94 calls, right? The next line up. And what puts? $90 puts, the next line down. That would get us into the initial strangle. Now, if we get into that and we come down to this $90 mark, what puts play? We're only talking puts because we're expecting to go to the bottom of the box. What puts play would we buy at the point where it hit this line? Would have to be like $89 puts, right? Because 88 is below this line. Now, in that perfect world scenario, again, if it comes down here to this 88.55 area, there's another set of puts we're going to buy. And it's based on our old bottom of the box line, which is just south of 87. So we would take $87 puts, right? Now, if we think about it, if we buy a puts play here, and then we have one line and two lines, when we make that third puts buy, what are we going to do also at this line? It pertains to the $90 puts we would be buying as part of the initial strangle right here. At this line, what are we going to do? We're going to put a trail stop that is equal to what, Ryan? %50 of what we paid for them, not 50% of what they're at. What that should do is that should allow it still to maybe even come back up to $90. Could it still be bearish and make an up move? Have we seen that before? Stocks just fell. Now they go up a little bit before they fall again. So could it still be bearish to come up here? And yes, in a perfect world, somebody'd say, well, why don't I sell here and buy again there? Because you cannot do that efficiently like you think you can. And those of us that have been doing this long enough know that. Many of you in this chat room that have been doing this long enough know that, I'm not even going to try to do that because chances are I'll be eating lunch. When it goes up to there, I'm going to miss it. Or when it goes there, I'm going to look at it and be like, oh man, this thing's going up, so I'm not even going to try to buy it. And then crap, I should have bought it. So we know that even things that are going down can go up some. So we would want to put a trailing stop that would be okay to that one line, but would not be okay if it went above that line. Yes, we are going to potentially give up more to gain more. And that's how you have to think of it. But we have to have a plan in place for the risk side, because we can't get caught staring at the moon and not realize we're standing in quicksand. There has to be an exit plan. So once we get down to this line and we buy some $87 puts on our $90 puts, if we bought them for $2, we'd enter a $1 trailing stop, regardless of what price they're at that time, right? If we paid $2 for them, comes down here, half of $2 is $1. That's what we would put on it. Down at this line, we'd also be doing that to the 89 puts we bought here, right? Down at this line, we'd also be doing it to those 87 puts. But we'd also be buying other stuff down at these lines, right? At what point in time do we want to stop buying puts? Does it have anything to do where the individual stock is? Doesn't matter. Any one of these 6 charts you see. Does it have anything to do with where they are? We will keep stacking the puts with this trading strategy until what happens? I don't want to specify the SPX being at the bottom of the box, although that was a great answer. That's what I'm looking for. I've got a pretty good history of being able to accurately call within 0.5% of the SPX movement, right? Of the SPX highs and lows. Nobody can dispute me on that because I can show you 2 years of video proof of where I've done it. That's not bragging. That's just, hey, let's keep it honest and do stuff that'll make us all better traders. I want you to put this in your note. We're going to keep stacking the puts until the SPX is within 0.5% of 1870. What does that mean? Are we going to wait for it to go 0.5% below? Or are we going to look at 0.5% from 1870 being 1879.35 rounded up to 1880? Allowing me to add something to our indicator chart here, right? This chart is an indicator chart. It's not anything more than an indicator chart. And I want to do something that doesn't throw us off. I don't want to use the red and green lines. Let's see. Let me pick one. I guess since this chart doesn't have pink lines, that'll be a bright line. I'm going to make it real thick. I'm going to stop stacking puts 0.5% from my target. Does anybody question why I want to do that? And let me get something straight. Do I know right now, without a doubt, it's coming down to that? No. Do I have good reason to think it will? Yep. But why do I want to stop stacking my puts within the 0.5%? What do you think? No, actually, it comes down to I take a lot of pride in the accuracy I've had on the SPX. But I can only say I've been within 0.5%. I cannot tell you one time I called the exact penny the SPX would bounce from or go to. I cannot tell you one time. I can tell you 71 times that I was within 0.5%, and one other time that I was within 0.64%. That tells me I need to identify my weakness, right? My weakness is that I haven't called it exactly, have I? I cannot gloat or anything else that I am any better than being able to accurately call it within 0.5%. That is the only thing I can gloat to. But I'll tell you what, being able to call something at that value within 0.5%, it's pretty good. You could say, well, that's still a $10 plus or minus. Okay. Okay. Be the guy last week that held all the puts positions and didn't buy any of the calls. Because I was expecting 1868 to 1870 and I didn't get it, but I got within 0.5% of it. I was expecting 1985 to 1995. I didn't get 1995, got within 0.5% of it. Could it even go up? Yeah, it might even go up 0.5% above that. Who knows? But I'm going to stop stacking my puts trades when the SPX hits 1880. So does that have anything to do with what value my chart might be at? No, it doesn't. Here's why. Can I go through years and years and years of charts for any stock and one of the equity indices and see that when the index went up, stock went up. When the index went down, stock stopped going up. And I can see corresponding up and down moves almost like they're waving together. It might be a day or two off. Might be even a couple days off, but primarily when one goes up, they all go up. When one goes down, they all go down. Talking about positive beta stocks. And anybody that spent any amount of time looking at charts could probably make that same correlation, right? But there's also times even with positive beta stocks that the SPX might have went to an all-new high and that stock only made a higher or a lower high. Yeah, that's exactly what I asked, Ryan. Because sometimes, like Apple right now, some stocks have moved more than Apple while the SPX moved a lot, right? So if the SPX says that's over, does it really matter that Apple didn't move as much as anything else? Or should I probably say, well, I guess it's over? Sometimes you have that. Sometimes you have one that, SPX goes up and your stock was going down, but it stopped going down, but it might have only gone sideways. But when SPX says it's done going up, guess what's going to start going down again? That stock that was already going down. So it really has little to no relevance at what each individual stock is actually at. I don't care if it looks like my stock's about to fail everything that's holy. Maybe it did fail a support. Did we have stocks the other day that failed what we had marked as the box before they went back up? Look at Facebook. The Qs, we had the box, did the same thing. It failed support. But guess what? The SPX said, I'm at the bottom of the box, time to go up. And what did they do? Netflix, CVX, these thick lines here, $80 on CVX, $105.50 for Netflix. That's what I assumed the top of the box would be relevant to their boxes during that time. Did it matter what those stocks were at when the SPX said I'm still going up? Or did they say, well, I guess I'm going up past the box? SPX says go up, I'm going up. Last week we talked about how CVX and Netflix hadn't gone quite down to what I assumed was the bottom of the box. Remember, that was down here. As has been proven, it didn't matter. The SPX went up and so did they, right? And prior to that, when the SPX went down, so did they. Well, and I understand that, and I'm not chewing on you, Ryan. I'm trying to get the point across that I don't care if the stock I've been watching only moved up 50 cents and everything else in its price range moved up 20 bucks. If the SPX goes down, I'm going to say, well, that sucked that it only moved 50 cents, but I'm going to ride that down wave now. But at that point, within 0.5% of the bottom of that box, I don't care where my stock is. I don't care what support it's failed. I don't care how many red candles it's made. you could say, well, coach, what if it keeps falling? What if the SPX hits and it does like Apple did last time, where it fell 2 days after the SPX bounced? You know, last week's webinar, we were looking at Apple like, holy cow, it's already $2 off the bottom. Next day, SPX gaps up, Apple gap down to the bottom again. Ran up a little bit, day after that, gap down to that bottom again. The what if my stock keeps going down, that question is going to be answered with the fact that those trailing stops that you had put in will still have you in trades, correct? And if it keeps going, your trailing stops are going to get higher if it keeps going down. But the fact that you have those trailing stops on there means that you could also focus on, if the SPX goes to the bottom of the box and comes back up, to rinse and repeat on the call side, right? Now we've seen the SPX go to the bottom of the box, go to the top of the box. We even saw it go just midway of the box, back to the top of the box. And we've seen it basically take 4 or 5 days, we'll say a week in layman's terms, to make its move, right? We could probably all agree that we've been about a week on the moves. Maybe a day more, maybe a day less. And us trading beyond that single week is allowing us also to take the, I'll just call it the other side position when we enter a strangle. The one that we're going to worry about trading the direction that it's moving. So if it's going up, even if we had to buy some puts, we're going to worry about trading the calls, assuming that we've given enough time that when it comes back down, our puts will be okay. That part's not going to change. The one final change, and I hope you put this in your notes, is why within 0.5% of the bottom of the box would I still want a pretty large trailing stop on all my puts? Pretty good question, right? Coach, I believe in the box. I've seen the box. Okay, but when it gets to the bottom of the box, why would I want to have a trailing stop that puts me a quarter of the way back up the box, right? Let's think about it in realistic terms. If I'm trading Netflix here, my bottom left chart, it comes down to the bottom of the box and we see that Netflix down here, why would I want to have a trailing stop that's going to stop me out literally like $3 above the current price when I'm at the bottom of the box? So the last part for your notes is when the SPX hits 1880, you're going to cancel all 50% trailing stops. Does that mean we just want to sell everything? Does that mean we just want to put it so tight that there's no room for the what if? No. At that point in time, again, seen through my studies of even what's just happened the last few moves, what we want to do is go from a 50% trailing stop to a 25% trailing stop. Now, you might be lazy and say, well, why don't I just put a 25% trailing stop in it from the get-go? You'll find out the hard way that that'll stop you out on a subtle move and not let you get to the bottom of the box. But once you get to the bottom of the box, the only thing you have left to keep you even possibly remaining in that trade is the what if, right? Now, I'm not one that's much of an advocate of the what if question. But I am one that's an advocate of what's wrong with tightening up your trailing stop a little bit and seeing if it does go down more. You're only going to be messing with profits at that point in time, aren't you? So when we see SPX at 1880, we're going to cancel all 50% trailing stops on our puts, and we're going to change them to 25% trail stops. What would that have done? Well, if I'd have done that when the SPX hit that 1990 area, CV up would have hit a lot sooner. The Netflix trail stop up here actually would have hit a lot sooner. It would have hit yesterday instead of today. Further tweaking an already good trading plan to get more out of it. Does everybody understand where I'm at so far with simple explanation of a simple trading plan and how you can trade it? Okay. Now, I know I tell people all the time, find charts you like, study them, and only trade them. And over the past few weeks, I've come to the realization that even though that works, if you're one that struggles with confidence, trade these 6 charts. Okay, trade these 6 charts. Why? Because these are the 6 you've been seeing me at least trading the past couple weeks in the exact way that we've talked about trading them. And it's worked. Very rarely are we making 100 buys on each chart. Actually, we've had a day where it's like, wow, we bought like something on everything. But we've never had a day where we're making like 10 buys on each of them. Netflix and Baidu can be a little bit expensive. The Qs, Facebook, CVX, and Apple are perfectly priced for anyone. Now, let's not venture too far from another aspect here. This goes in with the short-term trading strategy only. Even though I've said over and over again that our focus needs to be on short-term trading, I've never once said that you shouldn't look at any long-term stuff. You should just be heavier in the short-term stuff. I actually think that the top of this box here is the perfect time to take the chance on a couple swings. And I want to talk about those. If I'm at the top of the box, I'm assuming that anything that trades at a positive beta is going to go down if the SPX goes down, right? Fair assumption to talk about. I assume it'll go down if the SPX goes down. If you're going to be looking at swings right now, you need to look at the November monthly. It's November 20th is the expiration date. Let's look at something very, very simple here, just a bird's eye view. Under Armour had a double top, an M that went back down to the prior low and has now retested the M, right? And pulled back from it. Everybody see what I'm showing there? When do you buy on an M pattern? Right when it fails the M, or when? There we go. We'll use our prior low as a double bottom target, which would actually say what? Oh, that'd be like SPX bottom of the box, right? We don't want to look too far below that, but because it made a lower high when the SPX came to the top of the box, it's very, very possible we get a lower low. Using the November monthlies, but knowing that if all we do is go down to double bottoms, it's only going to take a week. Why do we know that? Because it's done it several times. Then we can pick a strike based on this target, even if we might have to sell at this target, right? So I could play the November 20th $90 puts, which are much, much cheaper than the $95 puts, right? And even though they won't be in the money, if it bounces off this 93.50 area, if it only takes a week to get there, I will still do what in relation to that trade? There we go. Last time I checked, trading was about how many times you can win compared to how many times you lose, right, Ryan? So Under Armour, looking at the 1120, $90 puts, but understanding we might just make a multiple bottom and sell here. We might do that. If it breaks below there, we got another target to look for. If it breaks below the 89.64, we have one more target to look for. That's almost going to look like, okay, when we had the big gap down day, forget about that. It almost looks like it came up to a right shoulder though, doesn't it? And there would be our third target point. Now, I'm a big advocate for scaling into trades. On this one, I'm not going to be an advocate for scaling in thirds. I will, however, be an advocate for scaling in halves. And if you use that Fibonacci extension, the 38.2 line comes out to 97.38. You fail 97.38, make your second buy. Yes, they will be about 350 at that time. But that's a good solid trade that most everybody can make. Another swing I like happens to be on one that we trade a lot that just made one hell of a move up. I think at first you got to trade it to just a retest of this $80 range. But I think when you really look at stuff here, you're actually seeing something more of what we talked about back here, aren't you? Remember what we talked about here, how it dropped that channel, but we were leaving it here because of how that double bottom occurred after it went back up to the top of that original channel. Hold on a second, I got the same thing. Oh, ooh. And it also puts me right back up into those swing lows from before. If I'm looking at something that, believe it or not, might potentially run over the next month another $10 up, but could fall another $10 to $12 down, what type of swing am I maybe thinking? I don't even have to be a genius. That sounds like it's worthy to do a strangle or straddle trade, but not trading out just a week or two. Look at your November 20th, 95 calls. They're 54 cents. Look at your 75 puts. They're 70 cents. Anybody here could enter that as a strangle. If you want one that might be a little cheaper, go with XOM. I wouldn't do COP though. I've just noticed lately, even though I used to really love trading COP, I've noticed its options aren't given the same volatility as other oil and gas stocks like CVX and XOM, which means that you could lose less, but it also means that you could make less. And even though I'm a big stickler on not getting caught staring at the moon, but standing in quicksand, we're still in this to make money, and I want to take the chances on stuff that can make me the most. Yeah, I think generically, Adam, I think that you would be fine buying tomorrow. If you want to if it gaps and you want to let it settle in for like 10, 15 minutes, okay. But I don't think there's anything wrong with making that pretty much your first buy tomorrow, okay? That one on CVX. You look at this Disney weekly chart, almost looks identical to the SPX chart, right? I mean, quite literally, if I zoom that in, wow, candle for candle, it pretty much looks exactly like the SPX. Take that over to your daily. And a decent single direction quick trade would be your 98 puts for October 23rd. I would even venture to say, why not go with the $100 puts, because they're only 80 cents. Not trying to add it to those 6 charts we're doing the strangles and straddles on, but looking at one that could be a single direction trade. Where would your stop be on that single direction trade? I'll make it really easy. Today's high a day. The high a day today at 104.51. Because if that's going to be the trade I just talked about, tomorrow we'll make an evening star. Where's your stop on an evening star? The high of the star candle, right? So that would be under the assumption that tomorrow gives you the 3rd candle of the evening star. So today's high would be your stop. Could you maybe get away with the 1016? I think you could. Is the trade a little safer to go to the 1023? Yep. Go any further than that, though, you're going to be paying some earnings premium. So if we make a move to the bottom of the box, Disney, 1023, 98 puts, or sorry, 100 puts, with a stop of any price above 104.51. Some of you might be needing a good long-term position. You might say, well, why would I buy this? It's like $5 off the bottom, $4 off the bottom. Look at your breakout pattern that's about to happen. Yes, it made the lower low here. You're absolutely right. So your assumption may still be that it's going to make a lower high, maybe even to retest that M, right? NEM could still be a very positive play on very cheap options with the 1120 $20 calls. That would be looking at about a 300% gain on intrinsic value alone just at the retest of the M. If markets were to get really ugly, guess what a negative beta stock's going to do? Get real sexy real quick. And you'd probably rather buy it, at least start buying it during this little break point than when it breaks 27.50. By the way, I am still long in a common shares position on NEM. I bought that common shares position back here. I traded the puts as the point where my common shares are free, but I'm holding my commons and I'm planning on buying some more. If the SPX pulls back from the top of the box, I'm buying more commons. Then I'll work on making them free. When we take a look at some of the bank stocks, the financial stocks, JPM has given us a lot of consolidation range. Today it came up and almost filled a gap. Could that mean something? Yeah, I'm actually more concerned that yesterday and today closed above the prior swing low, the M pattern that we had. I think it's an uglier chart, so you'd have to avoid it. You could go with a Goldman Sachs that, hey, held right at your M here and gives me a stronger technical play for a potential $8 down move. I would still, on this one, look at 1023. You could trade your 175 puts for a pretty good price. You just want to work your way in that spread. You know, right now 196 by 241. Maybe start with a 220, 225 bid. If you're looking for a cheaper one, STI did the same thing. And Morgan Stanley might need to go up a little more. But like we talked about, I was having a big talk with Moss about adding a financial to his long portfolio. And I said, stay away from Morgan Stanley. It's the more bearish chart. It had already dropped and made a new 52-week low. If it's the more bearish chart, wouldn't it be the perfect one to short? And Wells Fargo is kind of like that JPM. I really think it messed it up enough. Could it still go down? Yeah, but I think it messed up itself enough that I wouldn't go there. Huh, big old run on INTC, and where did it go? Just about filled a gap now, right? You see the inverted head and shoulders? Shoulder, head, shoulder, neckline, boom. Just like any other breakout pattern, you either buy it on the break or when it retests the break point, right? INTC, don't let it fool you. $2 move on INTC doubles your money. $2 move on Apple doesn't always double your money. On INTC it does. Why? It's a third of the price. That'd be like Apple moving $6. Those of you that like your trend lines, if you work your just little series of trend lines here and start to figure out something, you're going to find that, wow, I actually want it to go up just a little bit tomorrow. And about the time it would fill that gap, it would hit that trend line, right? Leonard is probably salivating right now. Because basically, if you were to fail that and you were trading that trend line, you would also be looking at where your bottom trend line would be. And man, that sure could get ugly. And a $10 move on INTC could be really good. Well, but Kramer doesn't say it's going up till it's at the high, Ryan. He needs somebody to buy them shares, right? There we go. Kramer +2. It sounds to me like you'll get a little bit of an up move tomorrow. And then it's going to fall. And if I'm going to go long, I need to look at this point right here, right? That's where it could still be bullish. Holding that. Watch your Kramer +2 weeks rule. How about challenge me on this one, Ryan? Why don't you keep track of that one for me? Even if it goes up to this trend line. Yeah. That right there. Tell me that doesn't hit within 2 weeks. Little personal rule I have, Moss. It's called Kramer +2 weeks. If I own anything Kramer talks about, I sell it the next day and I buy it again in 2 weeks. Why? Because, yeah, it'll probably go up that next day just because he talked about it. And then that way, when people come back and say, every time you tell me to buy something, it falls, he can say, no, I told you to buy it, and the next day it went up. And he can make you look bad for not selling it because you had the opportunity. But if I own something Kramer talks about, I sell it the next day, and I buy it in 2 weeks. Why? Because chances are it just retested a breakout point. And Kramer likes to tell me to buy at the high and sell at the low. Right? August 24th, what did Kramer tell everybody? And believe me, people, even dumb people, they look at Kramer and still say, you know what? Okay, he's not doing much of this stuff, or he's doing what he's supposed to do and what he's told to do with the show. August 24th, his quote, by the end of today, I am going to sell everything in my retirement portfolio. Whoa. He's not just talking about stuff on his show. He's talking about his money now, right? Kramer believed it so much, he sold at the bottom. Or at least he told everybody else to. Or was it the plot to, man, I like getting people to sell my shares or sell me their shares at the bottom and buy my shares at the top. If I tell them I'm selling my shares now too, they'll get it even lower for me. Oh. So Kramer +2. He talks about a stock. If you own it, sell it, buy it in 2 weeks. If you don't own it, watch it, buy it in 2 weeks. Because I will actually say the fundamental guidance he gives is top notch. And honestly, I'll give him the benefit of the doubt and say as a fundamental trader, which he claims to be, he does not care if it goes up or down tomorrow or next week. Well, when he says it's going down, it pretty much goes down. Because it's not hard to say when things go down. But then again, August 24th, he told us the SPX was going down, it's going to crash. So it might be a good day to sell your shorts. Hey, wait, Coach Mike told you to sell your shorts on August 24th. Huh. Anyway, INTC, a good little swing to look at. Now, I don't want to put a whole lot out there because I still don't think you should be going all crazy balls to the wall. I put out the ones that I like the best. And even if you got a little bit of an up move, INTC's $11, $20, $30 puts. They're 67 cents now. They go, if the stock goes up, you might get them for 60. And the way I would really look to trade that would almost be a 3-part scale in. Buy the puts, come back to this line, buy another puts buy, not necessarily the $30 puts, maybe go out to December and buy like 25s. Have 2 buys and puts and take another buy on calls, take $32 calls right at that midline for what if it goes up and what if it keeps going down. And that's how I would trade that one. Any questions on those? Do you at least see I like that list of charts for what it could do and the potential I said it could have, so long as what happens. Even those swings were contingent on what happening. The SPX has to do what? go down. Has to go down from the top of the box. And if it does, then every one of those trades I just went through, I like.